So good evening, everybody, and I welcome you all to this class for business valuation subject. I guess this is your paper number 20, if I'm not wrong. Yes, it is. Your paper number 20 has two parts. The first part is actually with respect to some strategic management thing. And this second part of your paper is regarding business valuation. So in today's session, though I intend to cover your study note number 6, study note number 1, 2, 3, 4 are for part A of this subject, and study note number 5, 6, 7, 8 are for business valuation. Though I intend to cover study note number 6, where numerical questions are there with respect to business valuation. But to begin with, I would like to give you some theory also about the business valuation. I don't know whether you know the scope of this subject or not, but let me tell you one thing, that I am a registered valuer. And I make valuation of equity shares, valuation of preference shares, debentures, optionally convertible preference share, cumulative compulsorily convertible preference share, optionally convertible debentures, compulsorily convertible debenture. I make valuation of goodwill, patent, copyright, trademark, customer relationship, employee workforce, sweat equity shares, employees stock option scheme, valuation of proprietorship business, valuation of partnership business, and so on. So you can say that, yeah, kind of, I practice a lot in valuation. There's a lot of scope about valuation. This is just not a subject of 50 marks, but this is a whole area for practice. This is a whole area where you can develop yourself and work for it. So as far as this hardcore theory is concerned, I'll teach you a part of the theory, but at the same time, I'll share my practical experiences also. For that, you need to take interest. If you take interest, if you keep on asking questions, good questions, then definitely we will talk about business valuation, right? So, okay, let's just do one thing. I'll tell you one interesting story first of all, and then we will talk about business valuation. Just a minute. So, how interesting is the valuation subject? I'll first tell you a case study, and then I'll proceed to your hardcore theory subject. And this is the case study which I have created today morning itself. So while reading business newspaper for the day, I came across this news. I don't know whether you are able to see it or not. So this is the news. Okay, let me just do one thing. I will kind of stop sharing my screen so that now look at this. It says Securities Appellate Tribunal okays the vote on Carlyle infusion in PNB housing. Oh, I think the words might have been inverted. But what is this all about? So this news is creating a buzz in the market today itself. And look at this. This is the share price. What is share price? So that is basically the people who deal in the capital market, they make valuation of a company. And if they feel that this company is worth 735 rupees per share, that is why they are ready to deal at this price. So this is the share price of PNB Housing Finance Limited, which is a listed company. And this is today's price itself. But if I just click here at the 6 months price of PNB Housing Finance, you will see a very interesting story. Look here. On 23rd of December 2020, approximately 6 months ago, the share of PNB Housing Finance was trading at 350 rupees per share roughly. And thereafter, from December 2020 till 16th of February 2021, this share was under the price range of 400 rupees per share. Thereafter, it was trading above 400. Then from March 2021, it again came in the bracket of 400 rupees per share, 400 rupees. It's below 400, below 400, below 400, below 400. And might be here, look here at this point in time. Here also it was below 400. In fact, on 25th of May, it was at approximately 400 rupees per share. You know what happened on 25th of May 2021? PNB Housing Finance Limited intimated Bombay Stock Exchange that we are going to conduct a board meeting as on 31st of May 2021 for considering infusion of fund in our company. That is making allotment of equity share in the company so that we will have more money in our hand. So they intimated to the stock exchange around 9 p.m. on 25th May 2021. So if you look at the calendar, 25th May 2021 was Tuesday. So Tuesday night, they intimated that we will have a board meeting on 31st of May. And on 31st of May, we will consider for infusion of more fund into the company. Now see what happens. This was 25th of May, right? What happened on 26th of May? The share price gone up from 403 rupees to 425 rupees. So share value, we are talking valuation, right? A day before, people were considering this is a share worth rupees 403. But a day after, they started considering, no, this is 425. And next day, on 28th of May, they considered it to be 438. By the time people got understanding that, okay, my God, board of directors is going to have a meeting where they will consider that we should insert fund. What is the meaning of inserting fund in the business? The meaning is very clear. With that money, they will do expansion of the business. If the money comes in, then you will do expansion of the business. When you do expansion of the business, then your profitability will also increase, obviously, for sure. If profitability of the company increases, then company will be in a position to pay more dividend to its investors in the time to come. And you know what is value of any item today? If you want to calculate of value, if you want to calculate value of anything in this world, there are 4 steps. Mind my words. Want to calculate value of anything in this world, not only share, there are 4 steps. Number 1, estimate life. Number 1, estimate life. Usually longer the life, higher the value. Suppose you want to buy a cow which is expected to produce milk for next 1 year, thereafter it will stop giving milk permanently. Versus you have a choice to buy a cow which has started giving milk now and expected to produce milk for next 7 years. So what do you think? You will be ready to assign a higher value to first cow or to the second cow? Obviously, you will be ready to assign value to the second cow because its estimated useful life is more. So usually longer the life, higher the value. You want to make valuation? Number one, estimate life. Number two, estimate cash flows over life. Yes, estimate cash flows over life. How do I estimate cash flow? Let's take example of the cow itself. Sir, this is a gir cow when it is expected to produce 5-liter milk per day for 200 days in a year. 5-liter milk per day for 200 days in a year. So this cow will produce 1000 liter of milk per year for next 7 years. This is a gir cow, therefore the milk is expected to be sold for rupees 70 per liter. So 1000 liter into rupees 70 per liter is equal to 70,000 rupees. But there is one thing, I need to have a caretaker for the cow. I need to feed the cow. I need to bear medical expenses for the cow. And then thereafter some packaging expenses for the milk. Then there are some distribution costs. I'll go to the doorstep and distribute it. So roughly 50% of the amount will be spent. So my sales revenue is expected to be 70,000 per annum. And my cost is expected to be 35,000 rupees per annum for this one cow. So this cow is going to produce milk for next 7 years. And therefore my cash inflow will be 35,000 rupees per annum. Estimate life, estimate cash flows over life. Now you must have studied financial management and strategic financial management. Once you have cash flows in your hand, thereafter calculate present value of all future cash flows. Calculate present value of all future cash flows. Suppose 35,000, I discount at the rate of 20%. Why do I discount at the rate of 20%? You know why? Because buying a cow is a risky business. Tomorrow it can stop producing milk. Due to some disease, it can even die. Okay, this is a risky business. So I say, what is the present value factor at the rate of 20% per annum for 5 years? Just a minute. So that comes around 2.99, 2.991. 2.991 is roughly 3. So this cow is giving me 35,000 of revenue per annum multiplied by present value annuity factor for 5 years. Let's say not 7 years, or just a minute, 1 divided by 1.2. So at the rate of 20% per annum, present value annuity factor for 7 years is 3.60. 3.60 multiplied by 35,000 gives you 1,26,000. Cow will produce 5-liter milk per day, 200 days in a year, that is 1,000 liter multiplied by 70 rupees per liter is 70,000. 50% is going to be the cost. So 35,000 is going to be cash flow for next 7 years. I want a rate of return of 20% per annum on my investment in cow. So 20% per annum for 7 years, present value annuity factor is 3.6 times. 3.6 into 35,000 gives me 1,26,000 rupees. This is the value of the cow. I will be ready to buy this cow for 1,26,000. If it is available in the market for 1 lakh rupees, I'll happily immediately buy it. Coming back to the PNB case study. So PNB valuation, PNB housing finance valuation. On 25th of May, people assigned a value of 403 rupees per share. But late night, there was an announcement that, okay, we are going to have a board meeting on 31st of May. So people started realizing, oh my God, board meeting, going to issue more share. They will have more money in hand. They must have expansion plan. They must be having some great business opportunity. That's why they are having this fund infusion plan. If profit increases, dividend will increase. If dividend increases, the current value of the share increases. Right? So on 26th May, the price gone up from 400 to 425. 27th May, 429. 28th May, 438. And now people started realizing, no, something big is happening. So on 31st May, see what happened. 28th May was the date, it was Friday. Saturday and Sunday stock exchange remains closed. On Monday, 31st May, in the morning at 9:25 a.m., the board meeting was conducted probably around at 9 a.m. So the board meeting might have been concluded, say, by 9:15 a.m. By 9:25 a.m., PNB Housing Finance Limited submitted to the Bombay Stock Exchange that at the meeting of Board of Directors, we have decided to infuse 4,000 crore rupees of fund in the bank. On that day, the market capitalization of the company was around 6,000 crore. Market capitalization of the company was 6,000 crore. Market capitalization was 6,000 crore, and the board said, we are doing this big thing. 4,000 crore rupees will be introduced in the company. And who is the investor? The famous Carlyle Group, a very big and wise investor group, who is having the fund in hand of $250 billion. So 31st May, the share closed from 438 to 525. See the history in last 6 months. In fact, in last 1 year, the share price had never been to 525 level. But here, it happened to be 525 rupees per share, because the board announcement was there. And then 1st June 630 rupees, 2nd June 693 rupees, 3rd June 763 rupees, 4th June 839 rupees, 7th June 881 rupees. So share which was worth 350 rupees 6 months before reached the top of 881 rupees. Why did it fail down? I'll tell you that story also. You know why the share price has gone up? This is all the game of valuation. People realize that, okay, Carlyle Group is going to make investment. So, and they are going to acquire 40% shares in the company. Now, Punjab National Bank is no more the biggest investor. It will come down to 20%. Carlyle Group will go up to 40%. And these are smart people. If they are coming in, this public sector undertaking is kind of indirectly converted into a foreign company. By just this one board resolution, this PSU type of company will be converted into foreign investor type of the company. And it will be very well managed thereafter. And the future prospects of this company is very good. And the share price gone up. This is the game of valuation C. And you see this steep rise in the value of the share, price of the share. But sir, what happened thereafter? Just a minute, please. What happened thereafter? See, one of the corporate governance person, a company which takes care of the interest of the stakeholders, they raised an issue. They said that, look, whatever is happening over here is not really good, because the company has agreed to issue shares to Carlyle Group at 390 rupees per share. 40% shares of the company are going to be issued to a new investor at 390 rupees per share. And see, thereafter the price has gone up to 600, 700, 800 rupees. Even today, it was 735 rupees. So the board of directors of the company have kind of done injustice with the investors of the company. Board of directors has done injustice with the investors of the company by issuing shares at a very low price. Shares should have been issued at a high price. They should have appointed a registered valuer, a person like me. They should have appointed a registered valuer who should have made valuation of the share of the company, and on that basis the share should have been issued. But PNB Housing Finance filed an appeal with the Securities Appellate Tribunal that no, we are in compliance of the law. Securities Appellate, see, SEBI said to the PNB Housing Finance, look, this is wrong, you cannot issue shares like this. They went to SET said, okay, wait for some time, on 5th of July, we will give our verdict. So therefore, now the price is, fluctuating. Still, the price is approximately double of the previous level. So this is how the share valuation thing happens. So this is, a very fresh new case study of today morning only. Now, let's get back to our business. This was just to demonstrate you that how exciting can be the world of valuation. Now, coming to your study material and some of the theory. Basis for valuation, principle and techniques of valuation, and role of valuation. One of the very renowned person in the area of valuation is Mr. Damodaran, Ashwath Damodaran. He said that valuation is not an objective exercise. And any preconception and biases, any preconceptions and biases that an analyst bring to the process will find their way into the value. So the first thing is, valuation is not an objective exercise, it is very much subjective. So suppose there is one unlisted company whose shares are not traded on the stock exchange, and I say, make valuation of this company. Valuation is there in IPL matches also. So the franchisee owners, they make valuation of the players, and accordingly they bid for the players, and accordingly they create their own team, and thereafter they play. Right? So somebody can say, okay, I am ready to buy this particular player by paying 2 crore rupees. Some other person will say, no, I don't think he is more than worth 50 lakh rupees for this season, because he is not informed this time. Valuation is not an objective exercise, it is a subjective exercise. If different people make valuation of a single company under similar circumstances, they can arrive at different values. In fact, the mistakes of valuers, his preconceptions and biases, will automatically be adjusted in the price. If I have a personal gut feeling this is a bad company, somehow I'll find data which shows that it is a bad company, and I'll input that data in my valuation model, and automatically the value will be lower. That was my preconception. And if there was a preconception from my side that no, this is a fantastic company, now this is called confirmation bias. Automatically I start searching for the evidences, for the data that supports that yes, this is a very good company, and I'll find only the brighter side of the company. Accordingly, I'll find the data, accordingly I input it into the valuation model, and then thereafter the value will be automatically higher. Okay, so this is an introduction. Okay, now when do I need a valuation? I gave you one example just now, that if your company wants to issue new equity shares, you need to do a valuation that at what price should I issue shares of my company? So at what time do you need a valuation? At the time of mergers and acquisitions. If two companies are merging together, you need to decide an exchange ratio. So sir, isn't it very simple that if two companies are getting merged, then I'll simply do one thing, that market price per share of one company is 400 rupees, market price per share of second company is 200 rupees. So the exchange ratio, if A Limited has a market price per share of 400, B Limited has a market price per share of 200. So B Limited's shareholder should get 1 share of A Limited for surrendering their 2 shares. The exchange ratio should be 1 share for their 2 shares. But you know, that is the exchange ratio calculated on the basis of current market price. But what do I want is a value. Maybe the price prevailing in the market at the Bombay Stock Exchange or at National Stock Exchange is not the true indicator of the value of the company, and therefore you need a valuation for this purpose. Then you need valuation for the purpose of business restructuring. You know, under section 66 of the Companies Act, there is a concept of reduction of capital. So I change rights and duties of some of the shares, and for that I need a business valuation. Initial public offering, at what price should I issue shares to the company? I need valuation. Shareholder dispute settlement. So company is going to start a new business and say one of the shareholders disagree, and to which management says, okay, fine, you don't want to continue with us, we will buy your shares. But at what price to buy the share? You need to make a valuation. You know, sometimes if the share is listed, you can simply take the market price as the value. If the share is not listed, definitely you will have to do the valuation. And sometimes even if the share is listed, you need to do the valuation because you don't have a faith in the market price per share. Purchase, sale of business interest and acquisition. Okay. Estate planning, deemed disposition at death. I will tell you practically where do you need share valuation. So this is one list given over here, and I'll share one list with my experience. The share valuation is required under the Foreign Exchange Management Act, under the SEBI Act, under the Income Tax Act, under the Companies Act, under the Insolvency and Bankruptcy Code 2016. These are the prime 5 acts where a share valuation, business valuation is required under the sections of the law. I repeat names for you: Companies Act, SEBI Guidelines, Foreign Exchange Management Act, Insolvency and Bankruptcy Code 2016, and Income Tax Act. Now, besides the valuation for the purpose of any law, one many times need a valuation for the purpose of entering into a transactions also, or maybe for settlement of family dispute. You might have learned somewhere that one of the richest person, Mr. Jeff Bezos, he got separated from his wife. They got divorced. And now at the time of divorce, there is a need to pay compensation because Mr. Bezos initiated that. So Mrs. Bezos was supposed to get compensated from Mr. Bezos, and that should have been based on the value of his wealth at the time of separation. So under family disputes also, one need a valuation. Okay. Now I'll tell you one interesting thing. What is the difference between the price and value? And also the cost. Price is what you pay to buy something, or price which you receive by selling something. But value is the future benefit. Price is what you pay, value is what you receive. I should say it like this: price is what you pay and value is what you receive. So suppose by paying a price of 5,000 rupees or maybe 15,000 rupees, you buy one mobile phone. So the price of this mobile phone is 15,000 rupees. But you know, you are so much benefited after buying the mobile phone. Earlier, you were not having the mobile phone. People who wanted to contact to you, they wrote letters to you, they come to your house and call you, and accordingly, you could got connected with them. But after buying the mobile phone, you got connected with the rest of the world very easily. Your business expanded, people could easily locate you, and now you're getting triple the orders which earlier you were getting. Also, you are getting news of what is happening in the entire world. So the value you are deriving from this mobile phone is much higher than the price what you have paid to acquire the mobile phone. Price is what you pay, and value is what you get, what you receive. Price is actually related to a transaction only, that somebody sold this thing at this price. But after buying this thing, my future benefits may be much more than what I paid, so the value may be much higher, or vice versa. I bought something by paying, 1 crore rupees. I bought a car by paying 1 crore rupees. And later I realized the value I realized by sitting in this car is not really high. The comfort is same as my 10 lakh rupees car. Speed I cannot have very much because the road conditions in India are not really great. In fact, my 10 lakh rupees car was having a great road clearance, and this 1 crore rupees car is just having a 6-inch of the road clearance, and every speed breaker, it hits the road. In fact, after buying the expensive car, many people started asking donations and money and everything. So I got puzzled. So the price I paid for the car is 1 crore rupees, but rather than deriving benefits, status, comfort, speed, I'm not getting status, I'm not getting speed, I'm not getting comfort, I'm not getting happiness. In fact, everything is reduced. So the value of this car to me may be less than 5 lakh rupees, while the price I paid was 1 crore rupees. Price is what you pay and value is what you receive. That is the difference. Okay. So this was some theory. Now see, let's just check this list. What is the purpose of business valuation? You do valuation for entering into a transaction. You do valuation for court cases. You do valuation for compliances. You do valuation for planning. Let's see what is written over here. Purchase and sale of an entity. You want to buy business, you want to sell business, do the valuation, and thereafter you can purchase the business. So years ago, the Tata Group acquired Jaguar and Land Rover. Before that, Tata Group acquired the company named as Chorus, right? Now it is named as Tata Steel Europe. So what do you think? What would have happened exactly? They went to buy Jaguar and Land Rover, and they might have asked, okay, allow me to speak some Hindi. If some of the people are from South region, please excuse me. So, bhai sahab, kaisa diya? Jaguar and Land Rover company kaisi di? And they should have said ki this is for 20,000 crore rupees. And Tata would have said, no, this is quite expensive. 15,000 crore rupees mein deta hai to de, nahi to main ja raha hu. To which he would have said, no, okay, we'll give you for 18,000 crore rupees. फिर टाटास ने बोला होगा, अरे नहीं छोड़ो ना, आपकी ना मेरी, चलो हटाओ, इसको अपन फाइनल करते हैं 16,000 crore में. You don't decide value of any other thing like this. If you want to enter into a transaction, your team enters into a due diligence. They study the company thoroughly. Thereafter, they make valuation of the company. And then you give your business proposal that I'm ready to buy this company for this price. So for purchase and sale of an entity, this is a transaction you are going to enter into. You make a valuation. Then mergers and acquisition, you need to make valuation. Reverse merger, where a small company is acquiring big company. This is a transaction you are going to enter into. You need a valuation. Then for the purpose of IPO, you need a valuation. Issuing shares, ESOPs to employee, you need a valuation. Buyback of share, say my company comes up with a buyback offer. So what should be the buyback price? What price should I offer? These are some of the examples of transaction. Now, valuation for the purpose of court cases like bankruptcy. Insolvency and bankruptcy code says that if you have gone insolvent, you are unable to make repayment of the bank loan. For example, you go to the IBC and say, see, we are kind of insolvent and kindly sell our company and, repay money to the bank, whatever money is realized, even if it is 25 paisa in a rupee, pay them. We want to get rid of this company. So for that purpose, also valuation is done. If there are contractual disputes, then the valuation will be done. Ownership disputes are there, valuation will be done. Dissenting shareholders are there, valuation will be done. Divorce cases, I told you one example of Jeff Bezos. Intellectual property disputes are there. Suppose I say that you infringed my intellectual property right. I have created a process, I got patented it, and without my permission, you are using my process. Or suppose I produce a movie and you create a pirated copy. I have spent 100 crore rupees to produce it, and you simply copied it and started selling it in the market. Do you understand? I sustained a loss of 200 crore rupees because of your this activity. And court found you guilty that yes, you actually pirated that movie. So now you should pay compensation to me. So what should be the amount of compensation? That compensation should be valuation of the intellectual property right. Now, valuation is also done for the purpose of compliances. So for the purpose of compliances, what do you need is fair value accounting and income taxation. You might be studying some of the Ind AS named as Indian Accounting Standards. So when the financial statement of a company are prepared, considering Ind AS in mind, then at most of the places in Ind AS, it has been specified that this valuation should be done. I'm sorry, you should not carry these items at the historical price. Rather than you should carry these items at the fair value. Carry these items at the fair value. This is named as fair value accounting. For that purpose, you also need valuation. Okay, I think this is enough of the introduction theory. Now we can directly come to some of the methods of valuation. Just a minute. Okay. So after this introduction, let's talk about valuation models. Study note number 6. We will be talking about discounted cash flow valuation, relative valuation, free cash flow valuation, valuation of firm from some other methods, and valuation of contingent claims. So let's start with discounted cash flow. Okay, let me tell you one thing, that for the purpose of valuation, there may be 3 types of approaches. Just a minute. Just like accounting standards, worldwide, there are valuation standards also. So like India, we have valuation standards issued by ICAI Valuation Standards 2018 are there. Internationally, we have IVS, International Valuation Standards. Then we have the Red Book of RICS, which is named as Royal Institute of Chartered Surveyors, and so on. Worldwide, just like accounting standards, there are valuation standards. And there is one thing common among all valuation standards, that valuation standards says that there are three approaches of valuation. One is income approach. Second is market approach. And third one is the cost approach. There are three approaches of valuation: income approach, market approach, and cost approach. I'll give you one quick example. So under income approach, there may be many methods. Let me clarify you one thing. There are approaches of valuation and there are methods of valuation. So any approach, see there are, let me type this, there are only three approaches of valuation, but there may be many methods of valuation under each approach. There may be many methods of valuation under each approach. So like, for example, under market approach, you can have market price method. You can have comparable company method. You can have comparable transactions method. Under cost approach of valuation, you can have replacement cost method. You can have reproduction cost method. Under income approach of valuation, you can have discounted cash flow method, or you can have, for example, option pricing methods. You can have, I'm giving you some examples, multi-period excess earning method. So there is no limit to methods. There may be, sometimes 10s and 20s and 30s of method. But as far as approaches are concerned, there are only three approaches. I was telling you, let me give you a very quick idea about how do I compare three approaches. Let's take that same example again for valuation of a cow. So what did you do? You said that cow will give me 35,000 rupees per year for 7 years. Now present value annuity factor at the rate of 20% for 7 years is 3.60. Therefore 35,000 into 3.60 gives me 1,26,000 rupees as the value. So what did you do over here? You just did one thing. You said estimate life, and in our example it was 7 years. Then you said estimate cash flows, and you said 70,000 rupees is the sales revenue multiplied by 50% is my cost. So remaining 50% is my cash inflow. Estimate life, estimate cash flow, and then calculate present value. So to calculate present value, you have suppose applied a rate of 20% per annum, and then total of present value is equal to current fair. So in our case, it was 1,26,000 rupees. Now, how come this 70,000 rupees itself? It was like 70 rupees per liter into 200 days into 5 liter per day. Right? The cow was producing milk 5 liter per day into 200 days into 70. So that is 70,000 rupees. This is what income approach, where you discount future income to arrive at current fair value. Now, what is market approach? Suppose here I want to make valuation of another cow which produces milk of 7 liters per day. So what do I do now? Produces milk of 7 liters per day. So what I say, that cow is worth rupees 1,26,000, which produces milk of 5 liters per day. This is kind of 1,26,000 divided by 5. So this is the market multiple. This is the market multiple. Have you learned, have you ever heard about the price to earning ratio? This is a concept similar to that. This is the price and this is the earning. This is market multiple. My cow is producing 7 liters. So 7 liters multiplied by 25,200. This cow should be worth 176,400. So market approach is a kind of shortcut to the income approach. You take the value of a comparable asset. Accordingly, you say, okay, for 5 liters, it is 1,26,000. So for 7 liters, it should be 1,76,400. This is the market multiple approach. Now I can name it as market multiple approach. Okay, Srinath is asking, can you distinguish between explicit and implicit cost? So look, Srinath, explicit and implicit value, not cost, in fact, you're asking. These are not popular terms. So in what context you are asking this, you need to be clear on that. Only thereafter I can help you to understand this. Okay? Just a minute. Let's see where in your study material this item is given. If you can show me some page number or something, then definitely I'll be able to help you out. Okay. Right, guys. So I was saying market approach, income approach. Under market approach, I gave you one example of discounted cash flow method. Under income approach, I gave you example of market multiple approach. And now let's talk about the cost approach. What do I mean by cost approach? So suppose I buy a calf, child of a cow, and that cost me whatever, say 20,000 rupees. And then I raise it for next 5 years. I have been feeding it for last 5 years. And approximately I have spent 70,000 rupees. So my total cost, including the interest burden, appears to be say 1 lakh rupees. 20,000 plus 70,000 plus some interest. So far I have spent 1 lakh rupees on this cow. And now it has started producing milk. So if I don't buy an already raised cow, I can invest in a calf and thereafter I can raise it. And accordingly, I'll have to earn 1 lakh rupees. Now, this is my cost approach. Let me tell you, in real life, the most popular approach of valuation is income approach. Thereafter, they talk about the market approach. And thereafter, they talk about the cost approach. These are the 3 approaches of valuation. So here, instead of cost approach, they have named it as asset-based approach. Look here, asset-based approach, income-based approach, and market-based approach. Now, within these approaches, there may be various methods of valuation. Discounted cash flow method. Relative valuation is nothing but the market multiple method. Contingent claim valuation is similar to option valuation method. Okay, so let's start with the discounted cash flow method. I have already given you a flavor of discounted cash flow method, but I will quickly give you one more example for the same. Discounted cash flow method for valuation. Suppose I have to make valuation of a bond. What is fair value of a bond if its face value is rupees 1,000. Maturity is 5 years. Interest rate is equal to 12%. Desired rate of return of the investors is 14% per annum. So what is this desired rate of return of the investor? So one who buy this bond wants to earn 14% per annum return from his investment. Now this actually becomes a discounting rate. This is the rate with which we calculate a present value. So I told you, how do we do the valuation? First of all, we estimate life. So here the life is 5 years. Then we estimate cash flows. 1,000 rupees into 12% is 120 rupees coupon. And in the last year, not only 120 rupees interest will be paid, but also 1,000 rupees redemption price will be paid. Life, estimate cash flows, calculate present value of these cash flows at the desired rate of return of the investor. Now use your calculator to calculate present value of these cash flows. I think you already know how to calculate present value of cash flows. Can I assume that you already know it? 120 divided by 1.14 equal to, and then you can keep it in memory, M plus, right? 120 divided by 1.14 equal to M plus. So 105 rupees is stored in memory. Now, luckily, the second year's amount is also 120. Therefore, you need not to start it afresh. You can simply press 1 more equal to. So actually 1 equal to you have already pressed. Now when you press second equal to, it becomes 92 rupees. And press M plus. Then another equal to 80 rupees 99 paisa, M plus. Then another equal to 71 rupees and M plus. But here another equal to will not work, because here 1120 is to be discounted. So you will have to type 1120 and then 1, 2, 3, 4, 5 times equal to, and then M plus. That is 581. Finally, memory recall. So now you type your answer, that what exactly did you get over here? Just check your answer. Have you got an answer like this? This is how you make valuation using the discounted cash flow technique. Estimate life, estimate cash flow, calculate present value of cash flows, and finally make a sum total. See, the 1,000 rupees bond is valued at 931 rupees, that is at a discount. You know why? Because the company is performing 12% per annum while investors are expecting 14% per annum. Company is performing 12% while investors are expecting 14%, and there comes the difference, that the expectation of investor is more than the performance of the company, and therefore this bond is valued at a discount. Rather than if suppose expectation of investor reduces to 8% instead of 14%, or suppose it reduces to 10%. Currently it is 14%, which is more than the interest rate. What if it becomes just 10%, which is actually less than the interest company is offering? In that case, what will happen? In that case, the bond value will go up to 1,075 rupees. If investor is expecting 14%, value is 931. If investor is expecting 10%, value is 1075. If investors start expecting exactly 12%, suppose, in that case, what will happen? The value will be exactly 1,000. If expectation of investor is equal to performance of the company, value will be at par. If expectation of investor is less than the performance of company, value will be at premium. If expectation of investor is more than the performance of company, value will be at a discount. This was valuation of debenture, but in the similar manner, one can also do valuation of equity shares, business, or anything else in this world. Okay. So thanks a lot for being here. Wish you all the best. Thank you. Bye-bye.